Right now, silver looks tempting. Prices are down, fear is everywhere. Social media is full of people saying the same thing. This is the bottom. But what if that feeling is exactly the trap? What if silver isn't offering an opportunity right now, but testing retail investors instead? Today, we're talking about the silver trap zone and why you need to be extra careful here. Stay with me, because this isn't about scaring you out of silver. It's about helping you avoid the most common mistake people make during volatile markets. The mistake that quietly transfers money from emotional traders to patient players. Welcome back to Silver Pulse. If you want silver market insights that focus on clarity instead of hype, go ahead and like this video and subscribe to the channel. It helps the channel grow and keeps you one step ahead of emotional market moves. So, what exactly is a trap zone? A trap zone isn't a single price. It's a psychological area where emotions overpower logic. It's where retail investors rush in because the price looks cheap, headlines sound dramatic, and everyone wants to be the first one in. But the market hasn't finished doing what it needs to do. In silver, trap zones usually appear after sharp drops. The price falls hard, then it stabilizes. Volatility slows down, the charts start moving sideways, and people begin to relax. That's when optimism quietly returns. Retail investors feel relief and jump in, thinking the worst is over. But very often, that calm is not strength, it's exhaustion. Smart money understands this pattern very well. They know retail investors hate uncertainty more than they hate losing money. So when that fear fades just enough, buying pressure appears from the wrong side of the market. This is why silver trap zones are so dangerous. They don't look scary. They look comfortable. Another reason silver is especially tricky is its history. Silver has a reputation for explosive rallies. People remember past spikes and expect them to repeat quickly. That memory creates impatience, and impatience is exactly what trap zones feed on. Right now, silver is showing many classic trap behaviors. Price volatility has cooled down after a sharp move. Social sentiment is split. Some people are screaming collapse, while others are screaming opportunity. That division is what keeps the price pinned in place. During real market bottoms, sentiment is usually unified. Almost everyone gives up. Nobody wants to talk about silver anymore. We're not there yet. At Silver Pulse, we don't focus on prediction, we focus on positioning. And positioning tells a very different story than the headlines do. When you start looking at market behavior instead of just the price, you begin to notice things. You'll see that volume dries up. Breakouts fail quickly. Rallies get sold off fast. These are not signs of strength. They are signs of distribution and uncertainty. Retail investors often buy because they think the price can't go any lower. But markets don't move based on what's fair. They move based on liquidity. And trap zones exist to attract liquidity from impatient buyers. Another big mistake retail investors make is treating silver like a short-term trade while emotionally believing in it as a long-term asset. That mismatch causes panic decisions. If you truly believe in silver for the long term, then short-term noise shouldn't control your actions. And if you're trading it short-term, you must respect risk and timing. Trap zones punish people who mix those two mindsets. Then there's the illusion of confirmation. During trap zones, you'll see plenty of bullish arguments floating around. Inflation fears, dollar weakness narratives, supply shortage talk. All of these can be true in the long term, but still be completely irrelevant in the short term. Markets can move against fundamentals for much longer than retail investors expect. Another key signal is how the market reacts to news. In strong markets, bad news is ignored. But in weak or trapped markets, good news fails to push the price higher. Silver has struggled to hold its gains even when supportive narratives appear. That's not an accident. This doesn't mean silver is dead. It means timing matters. The biggest danger in a trap zone is overexposure. Retail investors often go all in, both emotionally and financially, all at once. That leaves no flexibility. So when the price chops sideways or dips again, stress builds up. Stress leads to bad decisions. Smart money doesn't rush. They scale in. They wait for confirmation. Let the retail crowd fight each other while they sit back and observe. Another thing to watch is influencer behavior. During trap zones, the content you see shifts from analysis to encouragement. Phrases like last chance, never this cheap again, and once-in-a-lifetime start appearing everywhere. Those phrases feel good, but markets don't reward comfort. They reward patience. So what should you do instead? First, slow down. A missed trade is always cheaper than a bad trade. Second, separate your long-term belief from your short-term timing. You can believe in silver without needing to buy it right this second. And third, watch the market's behavior, not people's opinions. Trap zones exist to test your discipline. If silver truly moves into a strong accumulation phase, it will show it. Breakouts will hold. Pullbacks will be shallow. Volatility will compress before it expands. Until then, caution is not weakness. Before we wrap up, I want to hear from you. Do you feel confident right now or confused? Are you buying, waiting, or stepping back? Drop a comment below and let's talk. Different perspectives help everyone watching. And if this video helped you think more clearly about silver, share it with someone who might be rushing in emotionally. Sometimes the best move is simply not making one. This is Silver Pulse. Stay patient, stay disciplined, and I'll see you in the next video.